Yeah, I think you can think about it another way too, if you're concerned about this, about concentration risk, is that your compensation is tied to this company as well. So you're always going to be concentrated in this company, whether that's through compensation or whether it's through stock that you own in the company. So it's important to be actively thinking about diversifying your financial life, and seeing your stock-based compensation be just a piece of that, not the entire driver.
Executives that we work with, they're usually really focused on accumulating stock compensation and growing their wealth. We actually did a great episode of Off the Wall on executive compensation strategies with Laura Balser from Korn Ferry, so we'll link to that in the show notes. But I wanted to talk about the phrase sell strategy, because just as important as accumulating is knowing when to sell and what to do with all of this that you've accumulated. So when we talk about sell strategy, what does that mean? And how can we think about this in the context of market volatility like we're seeing right now?
So that phrase, sell strategy, to me, very simply means being systematic about taking your wins or leveraging your losses and reducing your concentration risk. So this should ultimately remove timing from the equation. Because your sell strategy should be consistent, it should be intentional, and it should be regardless of market mood.
Now, having a systematic strategy or rules around when to sell shares of your company stock can be challenging to navigate, especially if you have multiple sources of stock-based compensation like options and RSUs, or if you participate in employee stock purchase plans and accumulate shares on a regular basis. So what are some things you should be aware of if you're trying to build a sell strategy?
So a good wealth manager, I think, is going to help you try to avoid violating wash sale rules. So what is a wash sale? Let's decode that jargon. A wash sale is basically when you sell a security for a loss for the tax benefits, and then you go around and you buy the same or similar security. If you do that within 30 days of before or after the sale, you won't be able to take that loss on the security on your tax return. So wash sales are particularly important if you are purchasing company stock on a regular basis as part of, say, an employee stock purchase plan. If you own publicly traded stock, I think you can leverage such tools as direct indexing, which is a fancy way of letting you, quote unquote, work out of or sell over time, in more plain language, concentrated stock. So, and if you own private company stock, direct indexing can still be helpful with still be a helpful tool for diversifying your risk in your portfolio, maybe around your industry, for example. So what is direct indexing? I'm like just throwing out like all sorts of jargon in this answer, but I swear it's not as complicated as it sounds. So stick with me on this. It's going to be kind of a long explanation, but and it gets a little in the weeds, but I think it's interesting. So direct indexing involves usually individual stocks to replicate the performance of an index. So, for example, the S&P 500. You can go out, you can buy a mutual fund or an exchange-traded fund, often called an ETF, that owns a lot of different companies. So think of it like a basket of all the holdings in it, and you own the basket, not the individual holdings. So that's one way to go out and buy an index. Alternatively, you can buy individual shares of what's best for you, not the whole bundle, and still be able to replicate the performance of that overall index. So back to our S&P 500 example, you don't need to go out and purchase all 503 stocks in the S&P 500. You may be able to get a similar return by just owning significantly fewer stocks.